Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com comments on the markets and how gold, oil, the U.S., and Canadian dollars are doing. Rick Reaugh, CEO and president of Sprott USA Holdings, tells us about the current state of mining around the world and where he's putting his money. John Kaiser from Kaiser Research reports on what happened at PDAC in Toronto. He says there was a different state of mind at what had traditionally been a show about prospecting. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Well, it's good to be back. I had a little bit of sun for the last few weeks, and now come back to the north and find that it's still winter in Vancouver. Snow on the ground.
Yeah.
Very unusual sight.
Winter came to visit, and it hasn't left yet.
I know it was late in arriving, but yeah, we got our share of it as of now.
Yeah, we briefly joined Canada.
Yeah.
Ross, how has gold been doing?
Gold, it's just a fabulous move off the bottom for its seasonal play into the latter part of January, first couple of weeks of February, and that got up and produced some of the really good overbought readings that we look for with our sequentials. And when you look at the fact that it was up and teasing against the 5-year highs that we've had in that 1370 to 1355 range. And week and a half ago just started a nice break here. The end of the seasonal, you'd expect to see a good 38 to 50% retracement of the rally from the bottom. And as of this week, middle of the week, it was down 38% off the high. Spent a couple of days a little bit oversold, and a bit of a bounce into the end of the week at 1300. Looking forward here, we'd anticipate that 1265 is probably the most important support level over the next, say, month and a half or so. And on the upside, be surprised to see it go through 1306. That would be a 38% retracement of the break from the high that we've had. The commitment of traders numbers, which had been delayed because of the U.S. government shutting down for that period in December, January, the CFTC, the Commodity Futures Trading Commission, was unable to put out data during that period, and they've slowly been catching up on the data, and as of this week, they're finally current. So I haven't really talked about the numbers before recently because they were so outdated, but there was a 47,000 contract drop in both the long positions of the non-commercials as of this Tuesday, and there was a 46,000 increase in the short positions, or a decrease in short positions of the commercials. So those are good numbers. It's the first signs of a clean out starting to happen in gold, and I would suspect if we see this bounce falter below the 1306 and we go back down, you see a better clean out, and that could set us up for maybe later in the next calendar quarter for another rally. But for now, we're in that shakeout process.
How is crude doing?
Crude is working its way through that 10-year cycle that we've been talking about. The break in December was 45% off that $76 high that we've had. And you'd expect now to see the next 6 months off that December bottom rally as much as maybe 100% off the bottom. Typically it's been 75, 80 to 100% coming off the lows in the 8th year of the decade. So that was in 1988, 98, and 08. Coming off those, you get that very strong rally. In our case, this first move was up 36%, up to $74 within the first 2 months. It's a little ahead of itself. We were looking for a pullback, and at this point, $50 or thereabouts looks to be the support area. And if we measure and take a look at what would be the norm coming off that 10-year cycle low, we should be looking at something up in the $74 to $75 target as we move towards the summer. So, I think there's some decent potential there, but you want to buy the hard break. And we did see a nice move on Thursday and Friday on the downside, so this might be starting to kick it off. And Norway's sovereign wealth fund announced during the week that they will be reducing the size of their international holdings of the companies in the exploration business. Nothing in terms of the ones that are in the production and the flow of oil, but the ones that are in the exploration side of things. So that will and has put some pressure on some of these Canadian stocks at the tail end of our week in the oil and gas sector. I would suspect that there will be some just fabulous oversold readings here in the next couple of weeks, especially if we can get oil down closer to 50. And those could become good long-term buy and holds.
What's happening with the U.S. dollar and the Canadian buck?
The U.S. dollar has had a really good rally from an oversold reading in its uptrend on the weekly charts. It's managed now to push back up to the highs of the last year or so, but maybe a little bit ahead of itself. And it's due for a bit of a pause here, and that's giving gold that chance to have its bounce. The Canadian dollar had a good tail end of this week because the employment numbers were good versus the U.S. ones, which were absolutely terrible. So the Canadian was up about 1/3 cent. But if we look at the overall pattern of the Canadian dollar in the last month and a half, during December and into early February, you were seeing strength in the Canadian dollar along with the oil market and the CRB index, the Commodity Research Bureau index, which is good. However, by the time we got to the end of February, and there was that further push in oil and the CRB, the Canadian could not get through 76 cents. So it ended up putting in a lower high while both the oil and the commodity-related products were pushing higher. And any time we see a divergence like that in the Canadian, you do see almost immediate pressure to the downside. It usually starts within 72 hours or so. Last time we saw it was May of last year. We dropped from 78 down to about 74.5 in a span of about 3 or 4 weeks. This one has been from 76 down to 74 in just over a week. Bit of a bounce on Friday, but I would suspect that as long as we stay below 75 cents here, the next thing we should be looking at is a test of the lows that we saw last year.
Ross, thank you so much for chatting with us.
Nice to be back with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Rick Reaugh next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Rick Reaugh. He's the president and CEO of Sprott USA Holdings. He's speaking to us from Carlsbad, California. Rick, welcome back to This Week in Money.
Always a pleasure. Thank you.
Rick, you're at the PDAC conference in Toronto just the last few days. What was the mood like there?
You know, PDAC was interesting this year, at least in terms of the real veteran performers there. I would describe the circumstance as positive, but not euphoric. Good transactions backed by high-quality people are going to find money. The normal lame, halt, and blind aren't going to get funded. I found it to be positive but sober, a very useful atmosphere.
Did you get invited to Justin Trudeau's fireside chat at PDAC?
You know, as a matter of fact, I did. And I thought it would be better for all concerned, in particular my friends at the PDAC, who are responsible for relationships between the industry and the government. If I didn't show up, I didn't think my presence in that meeting would be useful to the mining industry in Canada, nor did I think it would amuse your Prime Minister too much. So I decided to pass.
What could he do to make mining better?
Resign? You know, Mr. Trudeau represents a sort of globalist, elitist point of view that somehow believes that we're in a post-materials world. They are more narrative-driven, in my view, than fact-driven. And, you know, I don't think, first of all, I don't think that his viewpoint, or the viewpoint of many of his backers and many of his ilk, is correct, factually correct. But I also believe that their narrative is in direct opposition to extractive industries. So I don't suspect that there is anything that he could do that would be supportive of mining, except that, of course, much of his political base, and he cares about his political base, is in Quebec. And to win Quebec, you need to deliver rural Quebec. So I suspect that he would need to find room in his narrative for rural economic development in the north and in Quebec, both in terms of mining and power. That would probably be the subset that he would be happy about. Well, not happy, but willing to back.
Barrick and Newmont, what are your thoughts on this battle over takeovers, hostile threats, all kinds of stuff?
Well, I'm not going to comment on who should win or who should prevail. I think the trend towards mergers and acquisition in the mining business is a wonderful trend. You and I have talked in the past about the fact that the mining industry suffers from too much general and administrative expense. And to the extent that a merger can be useful in removing redundant management expense, that's a very good thing. I also believe that the major mining companies would be well served employing Mark Bristow's investment criterion. That is, limit themselves to world-class deposits with 15% internal rates of return at $1,000 gold price. What's interesting about that is that over 5 years it would simultaneously, improve the performance of the majors, I suspect, while at the same time opening up enormous opportunities for the juniors. as they were able to buy assets from the majors that made no difference to the majors, in fact, assets that the majors had neglected, that could be transformative for some of the juniors. The third thing I think that's been overlooked in this that is of benefit to the juniors is that the whole process of laying off people who are redundant at the majors level opens up the opportunity for the juniors to hire those people. So I think the obvious benefits of the mergers occur in the sense that they almost inevitably deliver better financial performance among the majors. The overlooked part of the benefits of mergers to the mining industry is that they should simultaneously deliver an awful lot of benefit to the mid-tier and junior companies as a consequence of enhanced opportunities.
If geopolitical unrest is good for gold, why is it stuck in a trading range?
You know, I think that geopolitical unrest is an overlooked factor in the gold price. I'm not trying to say that it isn't a near-term stimulus. I think people use political unrest as a psychological tool to do something that they would otherwise do. I think the most important underlying trend in the gold trade for the last 40 years has been that gold trades inversely to the global opinion of the ability of the U.S. dollar, the world reserve currency, to maintain its purchasing power. There have been two prior times in my career where gold has done well in a period of a strengthening U.S. dollar. And in both of those circumstances, the things that propelled the gold price ultimately caused the dollar in the near term to roll over, which was very, very good for the gold price. I'm not arguing with you that past is prologue, but my suspicion is that while geopolitical events, global tensions may be stimuli for the gold price, the most important determinant for the gold price is, as I say, faith on a global basis in the U.S. dollar's ability to maintain its purchasing price. Particularly the U.S. dollar is expressed by the U.S. 10-year Treasury. And it's for that reason that I'm very, very bullish about the gold price, at least in the intermediate term.
Should geopolitical location be a concern for mining investors and speculators?
I think it should, but I would caution your listeners to understand that very few of us are able to judge geopolitical risk without an overlay of our own personal prejudices. We, meaning you and I, seem to identify with, in a negative sense, with political risk that we don't understand. We seem to deny to ourselves that money stolen from us by Caucasian males in English, according to the rule of law, is somehow less gone than when it's stolen by people who speak a language that we don't understand on a continent that we don't live on. My worst personal experience with political risk happened here in the People's Republic of California with the Castle Mountain mine, where most of the net present value was stolen from investors, according to the rule of law, by California legislatures. I personally now, as a non-resident property owner in the city of Vancouver, who, as a consequence of living most of my life helping raise money for Canadian companies, face the circumstance where the BC provincial legislature and the Vancouver City Council proposes to steal from me 5% of the value of my home on an annual basis. And yet they try to tell me that British Columbia is a favorable climate for investing. I think you understand my point.
Yeah, you'd like to live here.
Absolutely.
Where you put your money.
That in my own circumstance, I'm less afraid of non-North American political risk than many others are relative to North American political risk, which in certain jurisdictions like British Columbia and California I consider to be high.
Is the gold-silver ratio signaling that silver is undervalued?
I think technically perhaps that's true, although I've never understood really the importance of the gold-silver ratio. I think that things don't necessarily trade relative to their scarcity, but rather relative to their utility. I think gold occupies a place in the global investment mind where it's a store of value and simultaneously a medium of exchange. So I think that the perceived utility of gold is higher in many people's minds than the utility of silver. The experience has taught me that later on in a metals bull market, when gold is moved, silver moves further and faster, meaning that it seems like people's perception of the utility of silver as a financial instrument is as a speculative instrument, while gold is seen as an insurance instrument. So I'm not certain why the fact that the difference in their relative abundance in the Earth's crust, i.e. 16 to 1, and the variance of that from their relative market price, which is more like 80 to 1, or in reverse order, 1 to 80, is of any particular concern to anybody. That notwithstanding, many people believe it to be important, and I suspect that people will trade against it, merely as a consequence of the extreme variance that we see.
We'll have more with Rick Reaugh when This Week in Money returns.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Rick Reaugh. Rick, are gold and silver stocks far enough out of favor for you to look at buying them?
Yes. Not across the waterfront, of course, because most juniors are and always have been valueless. It's important to remember that. With that disclaimer, a small number of companies led by very, very, very high-quality people continue to generate enough performance that they add luster and credibility to a sector that's challenged. What's interesting about bear markets like this is that you can often buy the very best people in an assemblage for a fairly small markup to the general market, and that's very attractive to me. I have been allocating personal and client capital reasonably aggressively in the first quarter.
Do mining companies look to merge with or acquire other mining companies when stock prices are low?
Not as aggressively as they should, irrespective of stock prices. Remember that management teams are often more interested in continued employment and management emoluments than they are the betterment of shareholders. We are in a circumstance now where the owners of mining companies, that is the shareholders, including in particular the active institutional managers, need to take control of the process and force more mergers.
What is gold streaming?
A gold stream is most often a financial product where an investor buys for a down payment a certain quantity of gold over time at a fixed or floating price that's at a discount to market. Streams can either be on primary resources, that is, a financial instrument on the gold produced from a gold mine, or more commonly, buying the byproduct gold stream from a base metals mine, a copper mine, a lead mine, and a zinc mine. It's important to note that in the latter circumstance, where one buys the precious metal stream from a base metals revenue stream, that the transaction that occurs can be beneficial to both parties. the gold and silver revenue, when it's measured in the context of base metals cash flows, frequently trades at the market at between 5 and 7 times cash flow. That same revenue, that is the byproduct gold and silver revenue, owned by a royalty or streaming company, can trade at between 13 and 15 times EBIT. So unusually large transactions can take place where companies like Wheaton Precious or Franco-Nevada or Sandstorm buy the precious metals byproduct stream from a big base metals company in a transaction that lowers the cost of capital for the base metals company while being solidly accretive on a per-share basis for the streaming company. Truly a win-win transaction.
What's likely the next bullish sector in mining?
I don't know the answer to that. I am personally looking at the gold space because I think that higher gold prices are much more probable than not. And I'm looking a little bit longer term in the uranium space because uranium is selling at half the cost to produce it. And if the uranium price goes back to the cost that's necessary to produce it, my suspicion is that the market's memory of the last bull market would price the uranium juniors substantially higher. So I'm shading my portfolio to both of those commodities. But the truth is that I have always been more people-centric and more deposit-centric than I am commodity-centric. My largest junior position by a country mile is Ivanhoe Mines, which is in the copper business, the zinc business, and the platinum and palladium business. Not because I'm necessarily attracted to those commodities, but rather because I'm attracted to Robert Friedland, and I am also attracted to the fact that I have 3 Tier 1 superb deposits in one company.
Is uranium likely to provide safe, clean energy and replace coal?
I don't know that it replaces coal. There's a worldwide suggestion that coal should be phased out, even as, ironically, demand for both metallurgical and thermal coal grows. There are economies in the world that don't see themselves as being able to afford to generate the electricity that they need for poor rural populations to grow without the use of coal. I do believe personally that the world over the next 20 or 30 years is going to need a lot more of all forms of energy. Oil and gas, nuclear, coal, whether we like it or not, and alternative energies too. Looking out in the uranium business, if you can afford to look 4 or 5 years out, my suspicion is that the new builds in terms of nuclear reactors in China saves the price. The Chinese have looked at coal, and they said internally that they can't afford the particulate pollution that comes from coal. The Chinese government has suggested that 500,000 people a year in China die from particulate pollution as a consequence of air pollution. And they have both the money and the incentive, with horrible pollution, to switch from many forms of energy, including particularly coal, to nuclear energy. Other societies have had to make different choices.
Why are there no publicly traded thorium companies?
I think that thorium is perhaps a technology of the future. People get very, very excited about thorium. When I say people, I mean in particular journalists and academics. But if you look on a global basis, I think there's about $5 billion being spent, or $6 billion, on one thorium plant, at the same time that there's about $200 billion being spent on uranium plants. Not being smart enough personally to understand the technical debate between the thorium side and the uranium side, what I do is look at the informed decision of thousands of engineers, evidenced by $200 billion being spent on uranium and $5 or $6 billion being spent on thorium.
A junior mining company run by a geologist or a junior mining company run by a promoter. As an investor, which one would you prefer?
It depends on who the promoter is and who the geologist is, of course. An example, the best performing mining entrepreneur of my generation is Robert Friedland, who is not a geologist. He is the consummate promoter. He is, however, unique. So it really depends on who the person is rather than that person's training. There are geologists, I'm thinking about people like Robert Quartermain or Ross Beatty, who are simultaneously spectacular geologists and great promoters. There are promoters like Robert Friedland who have been serially successful hiring brilliant geologists. So I don't care so much about the educational background as I do the competence of the individual under consideration.
Are you watching any of the battery metals?
Yeah. I've been a long time skeptic about extraordinary price escalation in the lithium business as a consequence of the fact that the world has lots of lithium. Demand for it exploded before we could build the processing facilities to take advantage of the resources that we have. The fact that lithium has come down some in price means it might be attractive to me in 2 years or so. I am attracted to the cobalt space. Cobalt is the only material that I'm aware of where the users have told me that if you increase the supply of it, they'd be okay if you raised the price, that their constraints are availability. The problem with cobalt as an equity theme is that the places that produce cobalt in economic quantities right now seems to be constrained to Congo and Russia, two countries where investors are afraid. What investors seem to want in the cobalt space is politically correct or politically secure cobalt. Canadian cobalt, of which there's hardly any, U.S. cobalt, of which there's even less, or lateritic cobalt from Australia, which doesn't seem to occur yet with current technology and current energy prices to be economic. I'm a little less politically constrained personally, having made very good money in both Russia and Congo. So the cobalt space, politically challenged cobalt, is something that I'll be investigating with some vigor in the next 12 months.
Do you think you might own an electric vehicle anytime soon?
Oh, sure. Yeah, I mean, not as a social statement, but rather in sort of an understanding of the fact that my internal combustion engine probably has 700 parts and an electric vehicle has 2 or 3 in the engine. I like the simplicity of electric vehicles, and at least for the urban part of my lifestyle, they're attractive. I haven't seen one that has the combination of features and price yet that has appealed to me, but I'm certainly open to the suggestion.
We'll have more with Rick Reaugh when This Week in Money returns.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Rick Reaugh. Rick, what do you see ahead for the U.S. dollar?
I think the only reason why the U.S. dollar is as strong as it is the weakness of all the counterparties. Doug Casey famously describes the U.S. dollar as the prettiest mare at the slaughterhouse, meaning that its relative strength rather than being easy to equate with fundamental strength in the U.S. economy, has to do with the fact that the U.S. economy is healthier than most of its major trading counterparties. Where I hope I'm wrong, by the way. I'm an American. I live in the United States. I hope that the country's economy is stronger than I think it is. I think in the United States, given our balance sheet, that what we're doing is we're confusing liquidity, that is cash in the system that has to do with artificially low interest rates and the Trump tax cut. We're confusing the fact that we have cash with the fact that our current levels of debt and spending are unsustainable. And if the investment community comes to believe that the liquidity issues are beginning to overwhelm the good feeling that we have as a consequence of solvency, I think you might, come on to a very different set of circumstances surrounding the faith that we have in the U.S. dollar. I'm not one of these, by the way, who subscribes to that old gold bug saw that, we're headed into the Greater Depression, or in particular that gold is going to win the war against the U.S. dollar. I just believe that gold is going to lose the war less badly, which will be, I think, dramatic for gold. Or I shouldn't say something so inflammatory. Could be dramatic for gold.
Do you see the bull market in U.S. equities continuing?
It depends on the time frame that you're talking about. Buffett points out that 4 times, I think it is, during his stewardship of Berkshire Hathaway, the stock has fallen by 50% or more in price. I've been a Berkshire Hathaway shareholder for a very long time. And if you look at a 40-year chart of Berkshire Hathaway, it's ironic, but those 50% declines barely show up on a 40-year chart. So I am a believer in the 10 and 20 and 30-year outlooks for the United States. But the truth is, if you experience a 50% decline, while it doesn't matter much in a 15-year context, it's unpleasant during the time that you experience it. So my own personal belief is that sometime in the next 5 years, we experience a 30 or 40 or 50% decline in a broad index of U.S. equities. My suspicion is that 15 years from now, investors may have forgotten that. But it's a mature investor indeed who can overlook that circumstance during the time that it occurs and for the next year and a half or 2 years.
Could China's massive money printing affect the world economy?
Absolutely. Absolutely. They've done, they being the Chinese, a great job, and the Chinese leadership, at least on economic matters, has done a job that they haven't probably gotten sufficient credit for. On the other hand, a political system where 10,000 people rule 1.4 billion is a system that lacks sufficient feedback mechanisms, I think, to make the correct decisions over time. And an economy that's run at least partly for political purposes, where the banks are directed to prop up inefficient state-held firms, is an economy that runs the real risks associated with poor feedback mechanisms. So my nervousness really is the quantum and the opaqueness of Chinese lending more than anything else.
Is India going to surpass China as the world's biggest trading nation? People have said to me, well, they're a democracy, that's a plus, but the biggest negative factor is they're a democracy.
I'm not an expert on India. I think the Indian government's best course of action is probably one that they will never pursue, which is to say, get out of the way and let the entrepreneurial capabilities of the Indian people assert themselves. India is a greatly over-politicized society. If India took a page from China's growth, I think, really stems from a change in attitude evidenced by Deng Xiaoping, who said two things. The first was, it doesn't matter if the cat is black or white. What depends is whether it can catch mice. In other words, he wasn't wedded to communism. He wanted to have his people have a better standard of living. The second thing he said was much more dramatic, which was, to be rich is glorious. So to the extent that India decided to allow its population more economic freedom, I think you would see a tremendous increase in India. If you look at the success of the Indian diaspora around the world, Silicon Valley as an example, or where you are in Vancouver, particularly the Gujarati Ismaili diaspora in Vancouver, which is probably the most successful economic subset in the city, you get some sense of what India could do if Indians had the opportunity to get ahead. And one can only hope that that occurs.
Is the return of manufacturing to the U.S. good for the North American resource sector?
I don't know the answer to that. I don't know that it really matters, particularly who fabricates and manufactures an item. What matters is global economic growth. If copper is used in manufacturing a vehicle in China, or copper is used in manufacturing a vehicle in the United States, assuming that, probably a bad assumption, neither Xi nor Trump get in the way, the copper itself doesn't care where it's bought or where it's produced, nor, in fact, does the electricity that courses through the copper. My suspicion is that the methods that are being used in an attempt to increase manufacturing capacity, particularly in the United States, which is to say trade wars, depress the market for commodities. It is always consumers that pay the price of trade wars. Sanctions make everyone poorer. So the policy prescriptions in the United States and Canada that are designed to boost domestic production make the whole world poorer and probably constrain both economic growth and commodity prices.
We're hearing rumblings Canada might be in a recession. Is that good or bad for the resource sector?
I think recessions are bad for people. It would be probably good for certain investors in the resource sector that wanted to take advantage of lower prices following lower prices. In other words, should Canada dip into recession, as an example, asset prices in an already depressed energy sector would probably fall further, which would benefit investors that had the courage to buy those energy assets and hold them for 5 or 6 years. I don't think it would be good for Canadians on balance, because most Canadians have neither the financial resources nor the psychological resources to be real, true bargain hunters.
Would a stronger or weaker dollar benefit Canada the most?
It depends on who in Canada. A weaker dollar benefits exporters. A stronger dollar benefits consumers. So I suspect that depends on who you are. I'll leave it there. It really depends on who you are.
Do you have any thoughts on the Democrats' proposed Green New Deal?
She's a piece of work. I mean, it's been tried before. The strength in the United States dollar is that despite the fact that we're an extremely competitive society, we're losing. Not without a fight, but we're losing the war of socialist stupidity. The Europeans are 10 years ahead of us on the Green New Deal, which is precisely why you see the yellow vests marching in the streets of Paris. The Congressional Budget Office, as I understand it, has priced the Green New Deal and suggests that it would cost about $88 trillion to implement, $600,000 per working American family. Many of the prescriptions of the Green New Deal have been tried fairly recently. And in fact, I must admit that they have succeeded in reducing prices. Tried particularly in Venezuela, where in fact prices have reduced fairly dramatically. Unfortunately, as a consequence of the fact that incomes have fallen further, despite the price declines in Venezuela, the benefits of that are unaffordable. It would take real skill for American politicians to debase American society, but they're trying very hard.
Yes, go nowhere, visit no one. I mean, you look at Canada and the U.S., two of the largest nations on earth. We gotta move. Especially Canada. So much distance between each community. By the way, is climate change being used to drastically curtail mining in certain jurisdictions?
I think it's being used to drastically curtail all private economies. My joke is that although I'm technologically I'm an environmentalist. I enjoy natural environments. I enjoy hiking and things like that. Green, as it's currently cast, is, in my opinion, the new red. I see the green movement as being an instrument for social control. I don't, personally, myself, disagree with certain aspects of the concern with regards to climate change. The science, to me, hasn't been well documented on either side of the debate. And I personally believe that you err on the side of caution, meaning that you do whatever is feasible to do to restrict things like particulate pollution. But it's worthy to note that countries that are advocating a carbon tax aren't talking about making it revenue neutral. In other words, they aren't using the revenue raised from carbon to lower taxes elsewhere. They're, in fact, superimposing carbon theft on income theft, capital gains theft, and sales theft. You'll notice that I deliberately used the word theft to replace tax, to sort of describe how I feel about it.
Well, in BC, we've had a carbon tax now for a decade, and people still drive their cars. The money raised from it doesn't go to transit. And I don't see how a carbon tax can reduce volcanic eruptions or affect sunspot activity.
And it shows something about the cynicism of the political class. Similarly, your school tax doesn't go to schools.
Yeah. Well, typical government. In July, the Sprott Symposium will be in Vancouver. How's that looking?
Well, my favorite topic, of course. Every year, I think we go from strength to strength. Last year was the best one ever, and this year will be better. You'll recall that we've always brought a number of world-class speakers to Vancouver, and we're going to do that again. It's also worthy to note that at our conference, we believe the exhibitors are content too. Many investment conferences allow as exhibitors any public issuer with a pulse and a check that cashes, often in reverse order of importance. At Sprott, every exhibitor that we have is owned in Sprott managed accounts, meaning that we have vetted every single one. Doesn't mean that every stock will go up, but it means that we took into account the fact that the attendees at our conference view the exhibitors not as advertisers, but as content too. And for that reason, many of the attendees at our conference say it is the best conference in the world for mining investment.
Quality begets quality.
That's my suspicion.
Yeah. Rick, thank you so much for being on the show.
Always a pleasure. It's delightful to be able to address the Vancouver audience in your show. Thank you.
My guest has been Rick Reaugh, President and CEO of Sprott USA Holdings. Coming up, John Kaiser, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
AMY.V Resources Limited is a gold exploration company. with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with John Kaiser, editor of Discovery Watch, his website kaiserresearch.com. Welcome to the show, John.
Jim, it's a pleasure to be on This Week in Money.
And John, is it true you have a special offer for our listeners this week?
Yes, indeed, I do. There's a time-limited discount to the annual full access KRR membership. Its regular price is $450 US. The special price for listeners of This Week in Money to the end of March is $350 US. When you subscribe, pick the annual $450 individual membership and include this code in the box, TWIL20190331. The numerical part of that code is the expiry of this special offer. Do that and you'll get the $350 price instead of the $450 regular price.
John, you're fresh back from PDAC, the Prospectors Developers Conference in Toronto. What was your take of the action there?
Well, it's interesting. They just announced that 25,843 people attended from 130 countries, and that's not as strong as 30,000 or close to 30,000 in 2011, which was sort of the peak of the last bull cycle. We're now in the 8th year of a bear market since then. And so you think, wow, it's still going very strong. But when you look at a lot of who these people are, the PDAC has become to a large degree this big conference about social license issues, sustainability, corporate governance, environmental, financial, and technology innovation. You have the countries pitching the wonderfulness of them as a destination for exploration and mining dollars. A lot of this is more like bureaucrats type of stuff, crushingly boring for investors. So the PDAC is not what it used to be. There was a distinct absence of retail investors at this show, and I'll give you some examples of this. One of the companies that I follow, called Opus One, their head Louis Moran was telling me that in 2016, when we had that apparent turnaround, there was a lot of retail investors, high net investors coming back, checking out what was going on. It was a little less in 2017. 2018 was considerably bad, and this year they were almost absent. Now, this is a little Quebec grassroots early stage exploration junior, but what he did say is what was different was the producer types were starting to come around and just sort of kick the tires, see who is still in the game doing something. Now, another example would be Midland Exploration, whose Mithril project drilling will start in a couple of weeks. They made a discovery last year, which of course was still missing the third dimension, but it looks like a very substantial brand new discovery for the James Bay region of Quebec. And they had a lot of traffic from whatever retail investors were there, plus of course the bigger producer types checking this out, wondering if this is something they're going to have to act on. There's obviously no farm out potential there because Gino Reaugh said, "This is my Andre Gaumont moment. This is my keeper. I'm spending my own money on this one." And then a third example is Nevada Exploration Inc., whom I've covered for a decade now. Every year you go to their booth, there would be the team. They'd have their computer going. They'd be showing people stuff. This year, I would come there. I'd be lucky if I found one person at the booth. And the reason was, this year there was a surge of interest, not from these, retail investors who were largely absent from it, but from the producers. They were going through the presentation behind closed doors. They didn't want to have anybody see that they were interested in this. And so for that little junior, this was a very good show in terms of setting up all these contacts and finally being taken seriously. Now, in terms of bigger themes, the biggest theme was the sort of the battle between Barrick and Newmont. Barrick wants to take over Newmont and consolidate the Nevada assets. They now have a new CEO, Mark Bristow. Now he's a piss and vinegar entrepreneur who built Randgold from nothing, whereas Barrick had become one of these companies with a sort of corporate salaried CEO types. And he's in there shaking things up. And the spotlight on Nevada is interesting. He's called it this is like an ice cream factory, similar to the Witwatersrand. But what he apparently doesn't understand, that in the Witwatersrand, you just follow these quartz pebble conglomerate reefs down dip for enormous distances, and you got 2.6 billion ounces, of which 1 billion haven't even been mined yet because they are so deep. Nevada is far more complicated. And so another big theme at the show was the need to go to undercover exploration. And there was an entire session on Sunday devoted to this topic, a technical session. Because the big guys, they're looking forward. They're seeing that their major deposits are all depleting, that the stuff that the sort of juniors and that have is small. It's not really worth developing. They know they need to look undercover into the third dimension where there's nothing visible on surface. This requires new technologies. It requires the use of big data. And, of course, digital compilation has made this much more effective. And one of the companies presenting in there was, Nevada Exploration Inc., which has been flogging this hydrogeochemistry for 15 years, has spent $15 million, has never really had anybody's attention. And they got sort of two reactions. A lot of interest from these producer types who were in that session. Where have you been? Why haven't I heard about you before? And the other is, wow, but that's expensive, because undercover exploration ultimately requires drilling scout holes simply to vector in on your target to set up the sniper-type drilling where you hope to find a substantial ore body. And this is not really something that the juniors have ever really been financed to do. It's all been, give us $500,000 and poke a hole at a target underneath some outcrop, and we either get something or we don't. And the reluctance amongst the producers to spend the big bucks needed to find these monsters, that's also symptomatic of where we are in this overall cycle, which is that they've been consolidating their assets. We haven't had any help from metal price trends, and then they're thinking, wow, we got to spend $5-10 million just to put an elephant into the scope of our rifle. Wow, we're not really there yet. And yet the understanding of that was there. And the third theme, which was interesting on a Tuesday morning technical session, it was all about the western United States, a return to known districts. And one of the comments the guy made was that in 2018, there was a 17% increase in, from 2017 into 2018, was a 17% increase in spending in the U.S. And that's part of a broader trend of returning back to safer jurisdictions from these far-flung parts of the world where resource nationalism and all kinds of other issues are starting to kick in. So this sort of theme of, Nevada coming back into the spotlight, the consolidation amongst the big companies, and this return to these jurisdictions, this was sort of what I thought was the dominant theme at the PDAC.
We'll have more with John Kaiser when This Week in Money returns.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with John Kaiser. John, are you bullish on the TSX Venture Exchange and the CSE, the Canadian Stock Exchange, or do you fear the PDAC curse, the so-called curse, will hit them this year?
Well, Jim, it might be better for me to say I want to be bullish on the resource juniors. The PDAC curse is something I coined from observing over the past few decades that we usually have a great junior, in fact, have always had a great junior resource sector rally in the first couple months, which climaxes at the PDAC. And again, when in my earlier comment, the PDAC did not have that sort of exuberance, that buzz, that, where everything's going our way, it's going to get better. And invariably every year it goes down afterwards. Everything retreats. Now there have been exceptions. 2003 was an exception. That was when the Chinese super cycle started to kick in. 2006 was another exception. That's when the miners stopped hedging and said, oh, this China thing is real. 2009 was an exception when we were caught by surprise when China went on a spending binge after the 2008 crash. And then we had a long, dreary stretch until 2016 when the market thought, oh, we're finally coming out of this 5-year bear market, and it ran until August. Last year was different in that we did not have a PDAC curse either, but it was for a really bad reason. It was because there was no rally during the first couple of months from which the PDAC could retreat. It was a lame start to the year, and the year just got lamer as it went on. This year is even worse. This year it's been an even lamer start for the resource juniors. So there will not be a PDAC curse in that things are going to pull back from an exuberant start to the year. However, I think the context is different this year than it has been in other years. I think we will see a proper violation of the PDAC curse in the sense that the resource juniors will start to go up in the second quarter. It's not going to be a phenomenal uptrend, but we are very close to reaching a tipping point where finally capital starts coming back, retail investors start coming back, and part of the last couple years, it has been the cannabis bubbles and the crypto bubbles, which pretty much suck the oxygen out of the room. That, I think, is not going to be the case anymore going forward.
Just how much did those particular sectors, marijuana and cryptocurrencies, take away from the market?
Well, back in the 2011, the TSX Venture Resource Juniors, they dominated the trading value in the on that exchange, and it was sort of split. They usually had 50 to 60%, but in the last few years, the share of traded value from the 1,200 or so resource juniors left on the exchange has dwindled to something really, really, really sad. Like it's down in the sort of 15 to 20% range. And we had the big giant blow-off in cannabis last year. The crypto bubble is pretty much dead at this point. But the cannabis bubble is moving on. So we would have like these, $300 million trading days on the venture exchange, but the resource sector share would be down there at $20 to $30 million. So in terms of traded value, it has really, really diminished what's available for the resource juniors.
What sort of bubble can the resource juniors participate in?
Well, what helped the crypto and the cannabis bubbles along was this idea of a winner-take-all psychology, where anybody who's in the game in the beginning could conceivably be the one that becomes the next Amazon that ends up controlling most of an emerging space whose ultimate size is indeterminate at the beginning. And one of the reasons I say that the cannabis bubble is pretty much done as far as the risk capital is concerned is that after October 17th, it shifted into a different mode. We know who the finalists are in this winner-take-all race, and they're all competing to become the dominant parties if and when the American market opens up, legalizes marijuana at the federal level, and that's a market 10 times bigger. So all the losses that are going to be continued to be registered by the cannabis companies, they'll all be, dismissed as well. These are market development costs. But the little junior, the startup that wants to muscle into this space, they are now on the sidelines. There is no interest in that. So that type of bubble has disappeared. The resource sector does not have a winner-take-all bubble dynamic. I mean, it might be something like that in the case of very obscure metals such as niobium, where the CBMM with its absolutely massive Arasha deposit ends up dominating 85% of the market. And it could become something like that in scandium, which is sort of an emerging market, and perhaps the first mover will end up being the aggregator who ends up controlling the majority of scandium supply. But in the case of the resource sectors, there's only two types of bubble possible. One is what I link to metal price trends, and that tends to ignite a feasibility demonstration cycle where deposits found in past cycles and found to be wanting at the metal prices that existed, all of a sudden there's substantial real price gains that drag them into the money, and you can crunch the numbers, and it attracts institutional capital, and each one of these then goes into a valuation uptrend, and as long as the metal price keeps trending up, it's got a bubble dynamic to it. The other type is discovery exploration, where a junior with a, undrilled target suddenly finds that, pulls an intersection that says, we appear to have a very substantial discovery. And until you have drilled enough holes to find the limits of this discovery, you get this S-curve bubble where the valuation ahead of any resource estimate will end up achieving the value of what it is eventually worth, if indeed it is an economic ore body. And we have not had a market for either of these since 2011. We've had a couple attempts at discovery exploration booms, such as Novo and the Pilbara-Witsa 2.0 story, but nothing to really capture the imagination of the public. And the metal price trends, they have not done anything. I mean, gold has been bouncing between $10.50 and sort of $13.50 during this whole price, and all the base metals, although they haven't gone back to the pre-super cycle level, when you look at them in inflation-adjusted terms, they're kind of where they have always been. There's no real prices that are substantially higher than the inflation-adjusted special. So projects that don't work today at the prices that we have, they're not very interesting, and the super cycle from China is over. The markets for the base metals and that is back into a normal business cycle, and there's all kinds of concern about the, what is the trade war going to do? Is the global economy going to go into a downturn, which would be the negative part of the, the business cycle of all of a sudden here's all this mining supply and the demand goes down, so we see weakening prices. And in discovery exploration, where is that big discovery that has replication potential, that brings the retail audience back in, and also gets other juniors going because the glass is half full, and until proven otherwise, we are in the game of finding something similar, but the prevailing view right now is until proven otherwise, your story is a failure.
What kind of bubble can we expect for juniors exploring for base metals?
One of the sort of takeaways from the PDAC is the interest in the very big companies like Rio Tinto, Anglo American, BHP, in these very large deposits with this sort of undercover exploration as this unfortunate necessity needed to find the big sort of copper deposits of the future. And they're thinking in terms of the Indian super cycle and long-term depletion of existing mines. But when you look at sort of the India growth rates relative to the rest of the world and the existing mine supply infrastructure, it's 2025 before India, assuming it can overcome its bureaucratic handicaps, reaches that sort of China tipping point that we had in 2003, where all of a sudden the mine supply industry, with its sort of 3 to 5 year supply mobilization time lags, will get overwhelmed, and we get sort of the substantial, in the hundreds of percent real price increases in the metals that create the optionality. The only metal about which I am enthusiastic in the short term is zinc, and that's because China dominated so long. From 1980, they came out of nowhere. They ended up dominating 40% of global supply. They killed the price. They kept it low. So new deposits in the West weren't really developed. A bunch of them are depleting and recently depleted. There are new ones coming on stream. But if we simply have an ordinary macroeconomic growth trend, nothing special like a super cycle kicking in, there will be a point where there will be a zinc supply shortage. But the assumption out there is that even if this happens, we get zinc spike back into $1.50 to $2 a pound, China will simply fill that and just mobilize new supply. But the reality is, you ask any zinc expert, where does this Chinese zinc come from? And they scratch their heads and I say, we don't know. There is no big red dog zinc deposit in China the way there is the monster bionoble rare earth deposit where it's so big it'll produce for 100 years or so that they can just expand production from that. China's supply comes from many small operations which have been going for 20, 30 years. They're reaching their limits. They're being depleted. They're very polluting, and China is getting serious about cracking down on environmental pollution. So China's ability to ramp up supply in response to a stronger zinc price, I think it is very limited. We may even end up seeing a decline in Chinese output. And that makes projects such as Osisko Metals particularly interesting because they are revisiting the Pine Point camp, which Cominco abandoned in the 90s in order to develop its far superior red dog discovery in Alaska. And zinc's in the $1.25 to $20 to $30 range now. It could end up being in the $1.25, $1.50. It's not a spectacular increase. You're not going to see zinc going to $3 to $5 a pound. But in this $1.20 and higher to $1.50 range, a lot of these projects become very interesting. There's always this talk about copper and the electric vehicle stuff increasing demand, but that's a longer term picture, and it's not entirely clear that electric vehicles will end up becoming, have rapid large scale adoption, except in places like China where they have a strategic reason to get away from fossil fuel, gasoline, oil-based transportation.
We'll have more with John Kaiser when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with John Kaiser. John, 2011 saw a new type of bubble for resource juniors involving rare earths, whose market size is just a mere fraction of gold and the base metals like copper and zinc. Lately, we've seen mini booms in metals like vanadium, lithium, cobalt. How do security of supply bubbles work?
What happened in 2009 to 2011 was something very different for the juniors. It was a case where China, for geopolitical reasons, decided that it would limit the supply of rare earths to the rest of the world, in particular Japan, who uses a lot of the rare earths. China is the dominant supplier. 90% plus of all rare earths come from China. And we had these rare earths going from a buck and a half a kilo to over $100 a kilo. Those that were $50 a kilo went to like $1,000 a kilo. And it unleashed a major boom amongst the juniors who took all those forgotten deposits like Strange Lake and Mountain Pass and started to say, wow, at these prices, these things are way, way in the money. But the industry ended up responding by using a lot less of this material, thrifting, and China eventually backed off, and the supply squeeze ended. This fuss with the Senkaku Islands, who owns it, Japan or China, all that subsided. But the underlying reality still exists that China is the dominant supplier of rare earths. Now, back then, people weren't really concerned that, globalized trade would end up getting fragmented. It was still the idea the lowest cost jurisdiction deserves to be the primary supplier of the metals we need to keep our domestic economies going. And if the tussle between the United States and China gets out of control, we will have security of supply stories on a number of fronts where China is the dominant supplier. Tungsten's one of them, antimony's another one, rare earths, of course. But the other type of security of supply story is when a new application comes out of nowhere and generates unexpected demand for which the existing supply infrastructure is not geared to accommodate. And this is where the cobalt lithium booms from the past few years kicked in. As the electric vehicles started to gain traction and the car makers said, we have to be in this space, we have to make these, the lithium-ion battery was adopted as the primary battery. And lithium, of course, is critical to it, and there was a spike in lithium prices, but there's plenty of lithium in the world, and it's outside of China. The Australians have put a lot of lithium into production from their pegmatite bedrock sources. The Chileans have expanded the quotas that the existing handful of big producers can extract from the salars in that part of the world. So lithium prices have collapsed from lithium carbonate prices collapsed from $16 or $12-15 a pound down to $5-6 a pound. And so this supply lack of supply, it's being accommodated. Cobalt is different in that 65% of cobalt comes from the Congo, and it is critical to the lithium-ion battery, and it ran to $40 a pound in late 2017. But it's fallen back halfway. It's now $14-15 a pound. So all these projects that were supposed to work at the $20-30 a pound, they're underwater, and of course the Congo could undergo a civil war and have a big supply disruption. But China has its mitts into Congo, and even though Katanga has had its supply temporarily sterilized because there's uranium in it, and so they need to come up with a flow sheet to strip the uranium out of the zones that they've been mining, other operations have been able to ramp up, and so it is being met by Congo. But if Congo were for whatever reason to go offline, then you would have a serious supply problem. And vanadium is right now the popular metal in this category. This is long-term storage batteries. A certain type rely on vanadium, and we saw vanadium run from $5 to $10 a pound to $60 a pound. It's retreated back to $30 a pound, and that one's problematic because it comes from South Africa, it comes from China, and it comes from Russia, and they were not geared to accommodate a small surge, but they have the ability to absolutely flood the market. So I think the vanadium is again going to be a temporary problem, just the way molybdenum was. And the newest one that's come on the scene is palladium, and that's an interesting story because it was caused by Volkswagen's a diesel scandal of faking the emission results, and there's been a massive backlash against diesel. Demand for diesel cars has gone way down, and it's platinum that goes into the catalytic converters of diesel cars, and palladium that goes into that for gasoline cars. And all of a sudden, with everything shifting to gasoline, the demand for palladium has gone up, and one of the world's biggest suppliers, Norilsk, they've got a big expansion underway, but that's not going to be done until 2025 or somewhere like that. So now you have palladium at record prices of $1,500. And this is an interesting one, because if electric vehicles take off and replace the gasoline cars, well, then the demand for palladium palladium disappears. And of course, if Russia ends up in an all-out confrontation with the United States, well, then you're not going to get any palladium from the Reaugh mine. And if you believe that gasoline cars will continue to be around for quite some time before we have full-scale adoption of electric vehicles, the palladium space is one that might have some durability. So this is an area I'm watching closely because you have these nickel palladium deposits or systems in Canada which can't compete against big deposits like Reaugh's. But in a case like this where palladium is suddenly substantially higher and an essential ingredient in these gasoline car powered catalytic converters, you might have a boom reviving interest in these particular types of projects, and the juniors are the ones that have access to these.
Due to global uncertainty, could we see gold and silver spiking to new highs?
Well, this is a big theme that I've been pushing. I'm arguing that there's no point in seeing gold go to $3,000-$5,000 because we have fiat currency debasement or hyperinflation or anything like that, because the costs are going to go right up along with the price of gold. It's just a mathematical wash. But what's always interested me is what can create a real price increase for gold, the kind that makes a difference. So say inflation stays at its subdued level where it's now, less than 2%, and gold quietly over the next few years goes to $2,000 from its current sort of $1,285, $1,300 level. That's only a 50% increase. The optics are nothing like going from $260 in 1999 to $1,900, which was a 600% increase. But in real price terms, that is quite significant, especially when you consider that in 1980, when gold stabilized at $400, inflation adjusted to the present, that's $1,248 today. And yet in the meantime, 2.8 billion ounces have been mined in those 30 intervening years as a result of gold going from $35 to $400 an ounce. And so all that low-hanging fruit has disappeared, and what's left is high-hanging fruit. So, but if you get a modest increase from, $1,300 trending up towards $2,000, that turns a lot of high-hanging fruit into lower-hanging fruit. And I think we are into this trend because what can drive a higher real price increase in gold is uncertainty. It is uncertainty about the future, geopolitical uncertainty, big power politics, things changing. And gold is the easiest way to park money to ride out this stuff. I don't think that gold will replace the currency systems, but we're entering a period where the world wants to back off on its reliance of on the U.S. dollar, because the United States is shifting from a soft power hegemon to a hard power hegemon, where it's making unilateral decisions such as pulling out of the Iran deal and then telling the Europeans, even though you don't believe us that Iran is not in compliance with the deal, because you use the U.S. dollar, you have to obey our sanctions. And so the United States' current policy has put the world on a trend to back off from using the U.S. dollars. Now, that's not going to happen overnight, and hopefully eventually everything stabilizes, and you really don't have any other alternatives. I mean, the Chinese RMB, who wants that? The Russian ruble, who wants that? And the euro is in danger of the Eurozone disintegrating into a whole bunch of small balkanized type countries. So I think we are seeing a trend of uncertainty which will push gold higher. Back in 1980, when gold hit $850, that all the ground gold, above ground gold, that represented 26% of global GDP. Today, all the gold above ground, and that's almost double what it was back then, is about 9-10% of GDP. When everything was going swimmingly for the United States, it was like only 4%. When there was no concern around 1999-2000, that the winner of the Cold War would, end up ever, losing that position. But now we have a trend where China keeps growing, and even though the United States keeps growing, the difference between these two countries in terms of global GDP keeps shrinking, and China wants to be an equal power. And the United States is fighting that, and it's raising tensions trying to keep China from catching up to it. And that creates this groundswell of uncertainty that is going to attract gold or buyers into gold, and the existing owners are going to become more and more reluctant to part with their gold. And that's where you start seeing a real price interest that is of great benefit to the juniors.
Yes. Could gold bring a bubble back to the juniors?
If you take the 1980 spike to 850 with its 26% of global GDP peak and apply it to today's situation, it would be, the equivalent number would be $3,542. And of course, if we get back to peace and harmony and everything's wonderful, that 4% equivalent would be about $500, except that's below everybody's cost of production. So that would require everybody saying gold is obsolete, nobody wants it anymore. And I'm kind of inclined that things are not on a trend to get all wonderful and peachy. I think things are on trend to become ever more unstable. So we could literally see a spike in gold that surprises us. I'm not predicting it nor hoping for it, but I say we are in the zone where that could happen. And if it does, then the optionality plays all kick in. Then interest in exploration kicks in. But I think the kind of bubble that we would see in the juniors is more this idea, if we can break through 1400 and confirm that we are in this long-term uptrend, then exploration becomes interesting, because then if you find something that doesn't quite work at 1400, well, keep looking for something that's a higher grade within this system, and there's your S-curve type of psychology. And maybe by 2018 or 2020, what you found in the beginning ends up actually being ore grade because of this real price increase. In terms of a widespread bubble, I think it really would require the juniors getting capital, starting to make new gold discoveries, and this starting to replicate everywhere, and the discovery part being a key part of an uptrend in gold, driving capital back into the juniors. Not quite bubble scale, but definitely back into a bull market type of situation.
Have central banks been buying or selling gold?
The central banks were net sellers between 1972 and 2008. In 2009, they began buying again. And one of the distortions in this is China's central bank holdings. Now, they last reported that they own 1,843 tons, which puts them in about 7th or 8th place in terms of all central bank holdings, including the IMF as a pseudo-central bank. But China is the world's biggest gold producer, and they've produced 3,000 tons of gold in the last sort of 4 or 5 years, and they're the official buyer for gold. And what are they doing with it? Maybe they're not, the central bank isn't officially holding it, but other government entities, it's being squirreled away in them. If we assume China is not peddling its gold to its consumers, because that's not exactly a good message to encourage the Chinese. Don't hold RMB deposits, hold gold instead. That's not exactly what they want. And if they haven't been the source of selling out there, then if you take all that gold, they're about 3370 right now, which would put them in second place, and maybe 40% of where the United States is in terms of its official holdings, which haven't changed since about 1972 or so. And the Russians have been buying in the past year. Other countries like Turkey and Kazakhstan have been buying. The one that has been apparently selling, but not voluntarily, and which is causing the current downtrend, is Venezuela, some of whose gold holdings were pledged to loans, which apparently are not going to be repaid. So the collateral holders have been dumping the Venezuelan bank's gold into the market. But if we see an accelerated increase of gold buying by central banks, which in the current context is entirely feasible, especially if Donald Trump avoids, any sort of consequences as a result of the Mueller report, I think we will see the official bank buying accelerate, and that will also be helpful for the retail buying. And an interesting point is, when you listen to your typical gold bug, most of them are big fans of Donald Trump. And although what Trump's doing, cranking up the deficit, the debt, and that is no different from what was going on before, right now, a thumbs up for gold is perceived as a thumbs down for Trump. So the gold bugs are are not quite as enthusiastic about gold as they were back in 2011, except we have a situation approaching March 11th where the suspension of the debt ceiling on the U.S. debt, it ends, and it has to be either extended or the debt ceiling needs to be raised. And this time around, it's the Democrats who are in charge of the House, just like the Tea Party was in charge of the House in 2011. And you might say, are the Democrats going to be, civil and not risk jeopardizing the credibility of the U.S. dollar and then play this extortion game that the Tea Party played back then? Well, when you listen to all the rhetoric and the animosity out there, who knows what can happen? So we may enter another period here where gold becomes suddenly something that everybody wants to own, and because the traditional gold bugs have kind of abandoned it as something that they own, gold is available for the entire political spectrum to embrace. Imagine if all those people who watch Rachel Maddow on MSNBC realize that, no matter what she says, it makes no damn difference as to how things are unfolding. And they say, the only thing I can do is give a thumbs down to Trump by buying gold. Imagine this huge pool of capital that has never been interested in gold suddenly embracing gold and coming into it. I think we're sort of at a cusp where these sorts of shifts in perception about the importance of gold could happen. And it's not like the gold bugs are going to sell their gold, because deep down they know that these things that are happening are not really good.
Overall, are you bullish or bearish on Canada's junior markets for this year?
Well, one of the things that's still in a bull market is the regulatory attack on the resource juniors. The 1,200 TSX venture-listed resource companies that are still in that space, half of them do not have enough money to keep, or maybe have just enough money to keep the lights on for another year, and certainly no money to do any exploration that might make them worth something. And the big problem in the space is, where have the traditional investors in the resource sector gone? Well, the traditional investors in these resource juniors are people who are generally 55 or older. But the Canadian regulators have decided that if you're 55 and older, owning a high-risk resource junior is unsuitable for you. So they even refuse to take the order they didn't solicit, the one that you came up with. So all these people are being forced out into the discount brokerage accounts where they have to make up their own decisions, where nobody's guiding them as to what is a good resource junior and what is a bad resource junior. And then there's the younger generation who piled into the cannabis bubble, the crypto bubble, made a ton of money, in some cases lost a whole bunch of money, but they were all into that momentum trading aspect of these bubbles, and they look at the junior resource sector and say, well, you really don't have this type of a winner-take-all psychology there. You have a fundamental outcome limit. We can quantify what that is, but we don't know how to quantify. We don't know what that intersection of 10 meters of 15-gram gold actually means. So we have no gateway there, and the brokers are all into fee-based asset management. They don't want you to pick stocks in this. So the junior resource sector is being starved of an audience. It's being starved of capital. Even for the more advanced ones, the disappearance of specialized resource-focused funds. They've all vanished. I mean, we're now in the 8th year of bear market. They've had withdrawals. They've been doing nothing but losing money for their fund holders. And you have some generalist funds who also don't understand the space. So where's the capital supposed to come from? The system is very challenged. Now, I am bullish that if we get this gold uptrend coming, we will get interest in these discovery exploration juniors, the ones sitting on optionality deposits. If they rethink their system and say, is this really all that we have? And are we stuck waiting for gold to go to $2,000 for this to be worth anything? Do we have any clever geologists who can look at this data and see if there's something more? Can we do a digital compilation and apply new big data type of visualizations and see if there's a lot more? And maybe we can raise some money and explore this further. And this is indeed what's going to happen if these big mergers take place and they decide to divest themselves of these smaller deposits that maybe aren't so great. These will be acquired by all these shells being assembled with technical teams in place. In fact, Rick Reaugh in his newsletter presentation on Sunday said that, this is one of the things that he is completely focused on and expecting that these shell-type companies will do deals to acquire these assets that are not really, top-tier assets, and they'll raise money from part high net worth, part institutional, to show that, hey, there's a lot more to these projects than what was assumed by that prior exploration cycle. And at the same time, we will get the, optionality bet in case gold does go up. So I'm optimistic that we will see this, and I would say watch one of my favorite picks, which is Sun Metals Corp, with its Stardust project. They took on a project on which about 3 million tons of $150, $200 rock, copper, gold, silver, zinc, skarn mineralization was established in prior decades. They put $6 million into it. They came up with a hot hole, number 421, near the end of the season, where you have a substantially bigger intersection. It's a $500 rock at the grades that they reported. We have no idea what the geometry of this is, but they're geared up to launch an exploration program, a new drilling program to track this. And if it turns out to be something sizable, this will become a poster child for this whole idea of taking a system that's really not big enough and needs monster price to go high. And even if that does happen, there's other projects that have larger scale that would probably go into production first. But this is one where it could scale completely bigger at a better grade. If it works, it becomes a poster child for many other systems being also approached in a similar manner.
John, can you remind our listeners again about your special offer?
The special offer for a 1-year full access membership that gets you access to everything, including the search engine. It normally costs $450 US for a year until the end of March. You can get it for $350. When you register and subscribe and pick the $450 option, enter into the box this code TWIL20190331.
John, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been John Kaiser, editor of Discovery Watch, his website, kaiserresearch.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Reaugh, John Kaiser, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CEO Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Well, Jim, it's another Friday, and it's always good to be on the show.
You sharpened up your pencils and sent out another news release today. What's in it?
Well, it's a progress report on our Stage 1 and 2, which is going well. We have a lot of pregnant solution. It's 500 liters that has been developed so far, and that increases as we speak. So we're real happy with the progress that's going on. But there's a few things I want to talk about. If you look at the attachments to this podcast, you'll see there's an article on Apple and their progress in basically becoming a self-contained company that doesn't need mining material anymore. And it's an interesting article. There's another article in there by Jim Kramer on shorting of the Tesla shares, which has been going on for a decade now, and that's an interesting read because that's what's happening on the Canadian markets in a worse scale than the U.S. markets. The U.S. have at least an uptick rule where you can't short stocks down more than 10% a day. In Canada, there is no uptick rule, there is no short rule, and the creditors can short stocks down as much as they want, and there doesn't seem to be any regulation in how they go about doing that. If you probably noticed on our stock, you'll see there's a lot of crosses, usually depicting a downtick at the end of the day, and I question, coming out of the same house, whether there's any real change of ownership in that. But that's up to IROC to decipher. But that's what we're up against. But this release, and I did mention in that release that we had a lot of interest from battery manufacturers and EV manufacturers that are doing due diligence on us. Now, their timelines may not jive with ours, but we have a commercial opportunity here that people are not seeing. And, I'll give you an example. I was reading about a spark plug company in Japan who's really looking at getting into the battery business as heavily as they can because spark plugs are going to become obsolete here sometime in the future. So that's nothing you can't build your plan on that, something like the Polaroid. Yeah. And everything's just working for us. Markets are not terrific. And I used to write a letter that was called The Fundamentals of the Commodity Market, the metal commodity market, and I wrote that from 2008 till the first early in 2012. I stopped writing that. I had a big following in it, and I stopped writing it because fundamentals don't work anymore. Good example is you see the stockpiles are sliding on all your major commodities like copper and zinc, especially zinc is at the lowest levels. It's 5 years ago there was 800 million tons, or 800,000 tons. In the LME today there's less than 70,000 tons in the LME. So, and the price isn't going anywhere. And same with copper, nickel. All of them, the stockpiles are going down, which means that there's a good potential shortage, and but it's not reflected in the price of the metals. They seem to tag right along with it, like, we only got 100,000 tons of stockpile that could be eaten up in a half a day, and the price drops a nickel. It doesn't make sense. So I just wanted to point those things out. That's a reflection on what I see that doing is when the commodities are getting hammered, everybody's involved in manufacturing or whatever. They the prices of other shares that are especially in the commodity markets begin to fall, and for no rational reason. And if you read the Jim Kramer report on Tesla, you'll see that there's leagues of predators out there who hire stories, who speak a little bit of truth about something and a whole lot of BS about the other parts of it. And that's what people are reading all the time. But that's a negative, but I think that it should be pointed out. And anytime I see an article on it, I put it out there because I started reporting on this 6 years ago. And I may as well have been talking to the wall, but the predator trading is hurting the market. John Kaiser says that 50% of the venture exchange companies are underwater, have big debt, and no chance of financing this year alone. So, that's not a good picture for most of these companies. Some of them won't survive. But meantime, we're coming up with good results. ABBA all the way through on a very rapid timeline, and I really expect that we may get our patents next week. The patent number has been approved, so it's not like it's a real critical thing, but it's nice to have the patent number, that you can quote to somebody, or they can Google it and read all about our patents. And we're protected in 152 countries. So to say that we're in a good mood, we definitely are. Our own financing is going very slow, but it's coming through. And we are, talking to other people about the financing. And, of course, we'd really like to have a big partner out there, somebody who recognizes a commercial opportunity, that this could be a multi-billion-dollar business, just like the making of batteries are right now, and that they could be a part of this. They just have to come in with the financial clout. We come in with the technology, and we get a nice joint venture going, and we start to spread out through the, I'd like to say going viral, but it takes longer than that. But you got to remember that when you're looking at our opportunity, it's another mining opportunity, except that the resource keeps increasing, and whereas mining is a depleting resource, and you don't have the heavy costs of going into production in the billions of dollars or the hundreds of millions, our costs will be significantly lower. There's no exploration cost, very little on the EPA side of it environmentally. So, it's a really good field to be in. And not only that, but you can calculate what your resources are by just looking at the kilowatt hours. And that'll tell you what the material is in the battery. And so, everything's very, very positive. Like I say, I'm expecting, if not next week, early the following week, the final permit issue, or the patent number issue, and that's all good for the company. So I think it's going to be a good podcast this week, and there's some good material there that you can click onto that shows you where the market's going and what people are thinking about the overall markets and where we fit into it.
Larry, for people who are new to American Manganese, what are you all about?
We're a mining company, a critical metals mining company. We have some properties that have critical metals on them, especially our manganese property in the U.S. We haven't done a lot with it, but we do have a process that works on 2 to 3% grades, and this is what was the cornerstone of our battery recycling, which is another. I like to look at it as a mining prospect. Instead of mining ores, we're mining batteries, and we're cleaning up the environment, creating a circular economy. And we're on our pilot plant right now, so it hasn't been that long. It took 13 months to get the approval of the patent, which is a record. And We are traded on the Toronto Stock Exchange Venture under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM, and you can go and visit our website and at AmericanManganeseInc.com. You'll get all the information and the business plan and everything off of that website. You can contact the company or contact me at LREAUGH@AMYMN.com, or you can phone the office here at 778-574-4444.
Larry, thanks a lot for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. Our conversation took place on March 8th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.